following the stock market, you know that it's a meme stock world. In fact, I see it changing now more than ever, particularly when it comes to how to make money. The first big change I've seen is that people are seeking out stocks instead of other places to put their money. Since 2009, we've been living in a lower for longer American monetary era. So as the world changes, we must adapt with it. But as we end 2020, what's been apparent is that the world is changing now more than ever. So in this video, we'll talk about how we're going to change our approach, how we should be investing in 2021, and the mindset we should employ to do so. So as we count down the new year, there are a number of themes I think we should be paying attention to in order to help guarantee our success. The first is that people are seeking out stocks instead of other places to put their money. Since 2009, we've been living in a lower for longer American monetary era. Interest rates have been lower this decade than any in recent memory. Now, if you don't understand the implication of that, or talk about interest rates makes you bored, I get it. But here's what you need to know. Traditionally, a diversification into stocks and bonds and savings accounts, this was the common sense approach as to how to protect and grow your money so that you can retire comfortably, right? Well, here's what's changed very recently. Near zero interest rates have killed off the bonds and savings accounts where you would normally have put half your money. What compounds this is that these changes are here to stay for a while. The Federal Reserve recently announced rates will continue to be near zero through at least 2023. To see what this means, just look at the conventional approach, the gold standard as it relates to retirement investing. 60% equities, 40% bonds. If your goal was to have a 10% annual return, well, this mix got the job done in the 80s, the 90s, and the early 2000s. But not anymore. Now, bonds return zero. So should your retirement account have 40% of its allocation doing absolutely nothing? No, we have to replace bonds with something. And for many, that answer is stocks. But not just any stocks. We have to chase high growth stocks. Because stocks and assets that people understand will be priced as efficiently as possible. It's hard to make money with the majority of the S&P 500 right now. And sure, some may hate this change, but this change means opportunity for us. Now, what's happened is that opportunity lies in finding companies that are not well understood, yet will grow more than the market has priced in. This means high growth companies, otherwise known as trendy stocks and flashy SPACs. So again, as the world has changed, we must adapt with it. This means a new investing style. Not day trading, not value investing. We have to look further and further into a company's future. We have to resemble how VCs look at startups and apply that to stocks in public markets. More and more, we have to look at ourselves as VCs in public markets. Of course, given how public companies are much bigger than private startups, our goal is to find public opportunities that can at least 10x in 10 years. So when evaluating a stock like a VC, you need to look at three main categories: market, product, and team. This is because when a great team meets a lousy market, well, the market wins. When a lousy team meets a great market, the market also wins. But when a great team meets a great market, something special happens. So when looking at the market opportunity, data tells us that the ultimate size of the market addressed is the single greatest determinant of outcome. Let's start with the market. So here's what you need to know. Market size today matters little. What matters is the market's growth rate and how big it will be in 10 years. The number one mistake investors make when they miss out on a really great opportunity is that they look at the size of the market today, and they only care about how fast the startup is growing, and they don't care about the size of the revenue today. So you should try to think about how big it can be, but if you have to think too hard, it's probably not a good investment. The second is product, and this is definitely a hard one to look at, but I think the two characteristics a VC looks for, especially when evaluating for grand slam potential, is that there's evidence of product and market fit, and if it's unusual in its approach. Basically, product market fit is essential, but also top investors care about making crazy investments because most investments that end up being grand slams were not only right in the long term, but were initially crazy. So you want to find that sweet spot of ideas that are good and ideas that are crazy or seem somewhat unconventional for today. And somewhere in between the two, we find a disruptive technology shift. Finally, we want to look at the team, make sure they have both the experience as well as curiosity coupled with obsession. And essentially, you want to see bold thinking and authenticity, and that there's an indication of pure perseverance. Because unless there's a lot of passion that goes into building a startup, it's just not going to survive. And the same is true even with a large company. They're dealing with something that is disruptive and has a 10-year horizon. Well, it's going to take passion to get them there. So being a VC in public markets, if we can adopt this style, follow our curiosity, and try to pick the highest potential stocks, then I think we'll do pretty well in 2021 and beyond. But I want to hear what you think. How are you making picks in today's market? And what are some of your high conviction plays? Let's discuss in the comments below. And again, don't forget to join the 10X tribe. Come be a part of a community that helps take your trading to 10X and beyond. And make sure you end your 2020 with a beginning. I'll see you there, but until the next one, take care out there. Cheers.